While the S&P 500 is trading at all-time high, there's many high-quality, amazing companies trading near their lows. I'm going to talk about two of them in today's video. The first one is an amazing company that I think is very interesting, but I don't own the stock yet. The second one is a stock that I own, and I talked about it before, so I'm going to talk about it again. And I really hope you enjoy it as always. The first one is Fico. Fico is down 35% over the last year. Fico had a pretty amazing run over the last 2 years. It was up like 400% on its high. And from its high, it's down about 55%. And Fico's multiple was just too extended. The stock traded as high as about 80 times forward earnings. It was crazy, and people were trying to justify why it deserves 80 times because Costco trades at a high multiple. But that doesn't really work. I mean, Costco is, you could say, something that's a special case. It doesn't happen very often. Well, now Fico is trading at 20 times forward earnings. I mean, I never thought I would see an amazing company like Fico and with everything they do trading at 20 times forward earnings. Now, in terms of the business model and the moat of the company, I like to read the Morningstar reports because Morningstar, it's a great agency to analyze a lot of those quality companies. They're really terrible at analyzing growth stocks and speculative stocks. They just put in no moat and they don't understand the stock. But in terms of the great companies, they're good at it, as they have Fico at a wide moat with a $1,600 per share of fair value. Currently, the stock's trading at about $1,000 a share. Now, Fico makes their money in two different ways. The first one with software. They have the software revenue, which isn't really growing a lot, not even growing at all, but it has high margin recurring revenue and it's good for the company. The way that they grow their revenue, which is mainly 80% of their profits, comes from the FICO score. So in the United States, if I want to go out and buy a car, they're going to check my FICO score and they're going to pay FICO, I think it's like $10 or $11 right now, to get my FICO score, to know my credit history, to know if I'm really good, if I've been paying my debt, or if I've been just defaulting or doing whatever, and if I'm 90 days past due and on all kind of things. So the FICO score is the golden standards. Now, recently, the government has been saying that FICO has a monopoly, so they launched an alternative called the Vantage score. Vantage score is nowhere close to FICO, but the market is freaking out about it, and they say it could cause FICO not to be able to raise prices as much as they are, because the FICO score is like $11 and Vantage is like, I think, $2 or $3. But it's not really such a, I mean, it's just $10. Like if you're buying a house, the closing cost $30,000, $40,000. FICO is getting like, I don't know, $10 or $50 or $100 of that. So it's not really as bad as it is. Now, in terms of the competitive landscape, this is a very interesting article that was published on Housing Wire, which they reported in June that Fitch Ratings, which is one of the credit rating agencies, would cap non-FICO classic scores at 10% of the loan portfolio for residential mortgage-backed security ratings due to the lack of performance data of alternative scores. So the Vantage score and other type of scores, mainly Vantage, they're going to cap them at 10% because they haven't proven themselves in terms of a performance relative to the FICO score. FICO scores have been used for many decades, and Vantage is still not there in terms of the capability of assessing the performance of a lot of those loans. Now, interestingly speaking, the business model of FICO, I think, is misunderstood because there's two main use cases for the FICO score. The first one is to make an underwriting decision on the loan. Okay. The second one is as a benchmark for credit quality among stakeholders, origination, analysts, investors, and regulators. They said, we do not believe the underwriting use case is multi because Capital One uses their own score based on an information-based technology. Affirm uses their own scores. So a lot of those companies like Capital One, Affirm, and Upstart, and a lot of them, they don't even use FICO score to approve you for certain things. They pretty much use their own internal score. So this is not where the moat of FICO is. The moat of FICO is mainly in benchmarking, because whenever, let's say, there's a lot of loans, okay, and they want to package them up in a mortgage-backed security, they ask for the average FICO score. They're not going to ask for the average Vantage score. Or if even they use, let's say, they use their own scoring mechanism at Affirm or whatever, this scoring mechanism is not valid once they want to sell those loans in the public market, because investors are going to use, or they're going to ask for the average FICO score. And this is what they said. Even if the loans are not underwritten using FICO scores, originators still use FICO scores as a way of communicating their credit quality. For example, in CarMax, they disclosed that FICO scores are not a significant factor in their scoring model, but despite this, the firm's latest car loan-backed, asset-backed securities also referenced a weighted average FICO score, indicating that utilization of the product is effectively unavoidable when involving certain stakeholders. So if they want to sell those loans in the public markets, they're not going to be able to use the Affirm score or Upstart score or whatever it is. They're going to have to get the average FICO score. So there's really much no escape from using the FICO score. They can use Vantage to try to approve people and save a few dollars, but if they want to sell them on the market, they're going to need the FICO score. So for me personally, the way I'm looking at it, it looks like an overreaction. Like, yes, Vantage introduces some competition. At least that's what the market believes, and I think it's true. But I think, it's not really that big of a difference, a few dollars between each one. And if you're paying a few dollars more for FICO, you're getting a loan and a score that's been proven to work for many, many decades. And it's a gold standard in terms of originations and in terms of selling them in the public markets. Now, I told you guys, FICO is trading at about 20 times earnings, which is ridiculous. You look at the analyst estimates, they're expected to grow a lot. Even if half of them is true, it would be crazy. But if you look at the growth, they're expecting 44% this year, so almost done, 23% and 20% for the next 2 years. Now, if FICO remained flat for the next 2 years, the forward PE of FICO would be at about 16 times earnings. So the stock is really cheap over here. I don't see how it's going to be flat for the next few years. I think it's undervalued, and I would see, at least in my opinion, a 20% annual return from here. I believe that the Vantage score is real. There's some competition. At least that's what the market believes, so they can leave FICO alone. But I don't think it's as big as people are making it to be. And I think the sell-off is overblown. Now, the second stock that I own in my portfolio, and I've talked about it before, is a company called CEG, which is mainly Constellation Energy. The stock is down 24% year to date. It's been a disappointment in one of my holdings in my portfolio. I initially bought it at $155 in 2025, 2024. And I held it, been holding it for about 2.5 years, 3 years right now. And I continued to average up over time on Constellation Energy. Now, Constellation Energy is a utility company in the United States, mainly an unregulated utility company. They have nuclear fleets. They are pretty much impossible to replicate. You cannot rebuild any of those nuclear fleets. They are owned by Constellation Energy. It's pretty much impossible to do. They're building those SMRs, small modular reactors. They could be maybe done by the 2030s, but their power is nowhere close to the traditional facilities that Constellation Energy owns, and those facilities cannot be replicated. Now, the company is very large. It's so large that about 6.8% of the entire electricity supply of the United States is through this one company called Constellation Energy. And that, to me, is more of a national security play as well. And I would not be surprised if the government tries to take a stake in the company in the future, because it's so important to the infrastructure, so important to the grid, that 7% of the electricity comes from this one single company. Now, the reason why I liked the nuclear so much in the beginning is because they have something called the nuclear tax credit, or nuclear production tax credit. This is like a tax credit that gives the company a floor on how much they can charge for their prices, because it's not a regulated utility company, it's unregulated. If it's unregulated, that means the governments and local governments cannot set the prices of CEG. CEG's prices are set by supply and demand. So to make it profitable for them in the beginning, this is before the data centers, they started something called the nuclear tax credit, which gives them a floor of about 13% earnings per share growth from now to 2032. And it's not going to expire before then. And this tax credit evolves and it increases over time based on the inflation. So if inflation was, let's say, 3% instead of 2.5%, or instead of 2%, that would also increase the earnings per share growth. So I saw a lot of predictability in their earnings profile. But very recently, because of the data centers, they've been signing a lot of long-term contracts so much that they don't even need the nuclear tax credits anymore, because the rates they're getting for those agreements is way above market value. Like, this is a recent one with Walmart. It was the first ever, nuclear deal for Walmart. It's about 176 megawatts of nuclear power for two 15-year terms, beginning in 2029 and 2030. It's gonna be here for at least 30 years. So you're talking about a lot of predictability for the earnings. They also signed a 20-year deal with Meta and a 20-year deal with Microsoft at way above average prices. If you look at their total backlog right now, or total portfolio, about 30% of the expected baseload is going to be on agreements by 2032. It was an average duration period of about 18 and a half years. So 30% of their power is contracted for 18 years plus. This is a lot of predictability, a lot of recurring revenue, and a lot of it is way above the market rates, although this is what they said, but they haven't given us details on the exact pricing of those agreements. And, this is pretty amazing for the company. Now, in terms of the company's report, they reported great earnings. They increased guidance again to $12.50 per share, which is pretty amazing. Now, if you look at the company's longer term guidance, they're guiding 2028 to 2029 free cash flow before gross investments, which is mainly free cash flow included maintenance capex, so anything that they have to maintain. After that, they can use it for buybacks or dividends. If you look at this number, it's between 11.5 to 13 billion for 2028, 2029. The current market cap of CEG is about $98 billion. So this is about a 13% yield on the 2028 to 2029 guidance. And there's so much upside to this guidance based on different agreements that they can sign, based on certain buybacks. If inflation was above 3% or 4%, then that could boost it a little bit more. But the stock is very cheap here, in my opinion, trading at about 23 times forward earnings. You're getting, you could say, a bet on data centers without really betting on the compute and all of that. They all need power. CEG has the power. They have those nuclear fleets, cannot be replicated. They have the PTC contracts, or I should say the inflation production credits for 2032. And after 2032, they have an average contract of 18 and a half years at way above average market rates. So I see the company growing at least double digits. They said 20% in operating earnings for the next few years, and it's trading at about 23 times forward earnings. So I think Constellation Energy stock is undervalued. I think it was a little bit expensive, 35, 36 times. Now it went back down and the multiple is more reasonable. And this is the stocks that I have in my portfolio. I don't own Fico yet, but I'm monitoring Fico. And I think it's getting very interesting. But that was my opinion on Fico and CEG in today's video. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.